Greetings, Culturians, and welcome back to the channel. Today, we have to talk about Netflix and what happened after their really inconsequential bid came in from Warner Brothers Discovery, and also what happens when you raise prices on a bunch of people who are just sick and tired of that, especially for a subscription service that doesn't seem to have much to offer. Well, we got to talk about it, so here we go. Now, before we get started, just a real quick reminder, I'm trying to get to 50K. I can only do that with your help. So if you have the ability, please hit the hype button right away. Then double check you're still subscribed. If not, click on the red or whatever color it is button that says subscribe and turn it to a different color. And then hit the bell icon and turn all notifications on. After that, I just want to say thank you because you just did the 3 most important steps to make the channel successful and to bring entertainment back onto line, because that's really all we're trying to do. And we're going to start with the story, and we're also going to finish with the story coming out of That Park Place. Netflix sees stock drop after Warner Brothers Discovery deal falls through. And while that's true, it's a little more complicated than that. So let's jump into the story. The aftershocks of Netflix stepping away from the bidding war for Warner Brothers Discovery are beginning to ripple through Wall Street. On Friday, Netflix stock saw a drop of around 10%, posting results that slightly exceeded expectations, but the Q1 earnings call wasn't anything special. At first glance, the numbers looked fine, but investor reaction reveals uncertainty when it comes to the company. And there's a reason why, a pattern why. There's a lot of stuff going on in the background. We have to talk about press releases that went out late last year that were trying to get investors inspired. In fact, let's talk about that next. You see, they released a press release on October 30th of 2025 announcing a 10-for-1 split, taking the $1,000 price point and dropping it to around $100. The goal was to, have more capital raised over the course of their pursuit for acquiring Warner Brothers Discovery. Of course, they didn't say anything about that, and when it was executed on November 10th of 2025, this deal kind of went forward. So the split adjusted basis for the market opening didn't fall until November 17, and we ended up where we are today, which seems to be at a value that seems to be tailing off for Netflix, as you can see here in this chart. They're down to 94.22 after being at a high of over 100. In fact, the last few months since the stock split, things have not gone their way. They've gone very much down. And that's not a pattern or a trend that you want the market to pay attention to, but unfortunately, it's all anybody's talking about. Well, there's more reasons why. And again, it comes back to this deal. The BBC reporting on the fact that Paramount set for $111 billion Warner's deal takeover after Netflix dropped their bid, which again was much less than that. It wasn't all cash, and this story broke around February 25th, 26th. We reported on it here on the channel, in fact, and I know we talked about it over on That Park Place. But then they followed up recently, in fact, a few weeks ago, with this announcement. CNBC reports that Netflix raises prices across all streaming plans, which was a bad plan for Netflix because they always lose subscribers. They went up for a minimum of $1 across every tier. And for the first time since January of 2025, they've increased the price again. The price hike comes as Netflix has been investing heavily in its content, including new ventures into live streaming spaces, launching video podcasts, and of course, working with the Obamas, which hasn't helped things at all. Extra member pricing was also increased, which means if you wanted to add household members, well, that's going to be more expensive too. So let's take a look at the article from the BBC. And it says your Netflix subscription just got a little more expensive. The streaming giant adjusted its pricing structure with all subscriptions tiers rising at least $1. And that's just the way it is. The company's ad-supporting plan is now as low as $8.99 a month, up from $7.99. The standard plan is now $19.99, up from $17.99. That's a $2 jump, in case you're paying attention. And its premium plan went from $24.99 to $26.99. That's insane. Extra member pricing also increased. Ad-supported plans now costing $6.99 per additional non-household user, up from $5.99. Again, they're trying to do things by locating out of household people, but I have a feeling this is going to go very badly. Look, Netflix is no knight in shining armor here. They were not going to do a good thing or a good service by acquiring Warner Brothers Discovery, so I'm glad that didn't happen. I'm looking forward to what Paramount can do going forward, because 30 films a year with all the studios they control sound pretty good to me. Sounds like a direct competitor to Disney, and Warner Brothers Discovery with Netflix never would have been that. In fact, only Comcast could have brought something else into the fold and been able to benefit from it. I don't think a technology streaming service with some political problems is going to be the high end of the stick. Regardless, we have to look one more time at the article written by Trevor over at That Park Place. So let's jump there. So what's driving the drop? Well, the reasons that the Netflix drop is happening is multifaceted. The streaming giant projected softer than expected growth, which is what I actually think the investors are worried about, because there's not going to be any growth. There's going to be not just stagnation. This thing is going to go backwards. There's no slowing of momentum. It's going to be a complete cessation of momentum and a slide into decay. At the same time, Netflix is maintaining a full year forecast even after implementing some price increases, raising questions about how much those hikes will translate into sustained revenue growth. Well, content costs more. It costs more to make. It costs more to buy. And I have a feeling that the other elements of the streaming service, which are all the other studios, are maybe going to pull back from providing stuff for Netflix in the future. They were fine with this model working once before, but maybe not so much anymore. And there's been a lot of investor hesitation around Netflix for quite some time, and there are very few good shows. I mean, One Piece being one of them, and that's pretty much it. So adding to the tension is a lack of clear direction around Netflix evolving strategy, which seems to have been the stumbling block for them to just get the Warner Brothers deal done. And I have to say this, the studio consolidation in mergers are going to continue to happen. It's going to expand content libraries, distribution power, and global reach. And Netflix remains largely independent. And they are really having a hard time convincing the market forces that they want to be in theaters. In fact, Amazon may be able to sell that because they've been doing it lately, but I really don't see Netflix as doing much participation in that area, and that's going to hurt them in the long term. The stock drop suggests that some investors are beginning to question whether it could become a limitation that they really don't have anything to grow on. And the IPs that they have, well, if they ruin them, then nobody can sell them. And that's kind of the position that Disney finds itself in these days. The company's decision to exit negotiations for a potential acquisition of Warner Brothers Discovery was initially interpreted by some as a financial discipline. That is not true. Some could argue it stood in sharp contrast with David Ellison's win-at-all-cost measures at Paramount Skydance in securing the final bid, yet returning to a traditional model in an evolving media landscape carries with it the potential isolation in an industry that's getting bigger and more interconnected. And honestly, that's not a bad thing. But we can't put all of our eggs in one basket. We need multiple baskets. Cultural relevance is something that Disney is afraid to lose, which is why they're signaling they're going another direction, including in their messaging, which I don't find surprising, and I don't think you will either. I think that going forward, the model is going to be appeal to the broadest audience you can, and not to that tiny sliver of people who are politically correct in the right way. But hey, those are just my thoughts. What are yours? Do you think that Netflix is on the verge of a tipping point? Do you think they could continue to descend downward in the stock market? Do you think they have a chance to go out and acquire some other studios, maybe get a hold of Lionsgate or something like that? Or do you think they're going to just continue to go out on their own and keep making politically divisive entertainment, which I don't call entertainment. I call it lecturing and hectoring and propaganda. But hey, that's just my opinion. What's yours? Let me know down in the comments section below. As always, be sure to take care of yourself, take care of others, and until next time, see ya. Just not subscribe to Netflix.